So welcome everyone. Thanks for tuning into Sharesies Share Club. So I'm Sonya, one of the co-founders of Sharesies, and we'll be facilitating the conversation tonight. First off, we'll introduce Pattrick and Stuart. So we've got Pattrick, who's got the blue background, and Pattrick is one of the founders of Business Desk, which is a news site. And then we've got Stuart, who's the Chief Investment Officer at Smartshares. So maybe kick off with you, Pattrick, if you can just introduce yourself a little bit, and if you can do that.
Will do. Okay, so Pattrick Smellie, I founded Business Desk in 2008 for the younger Sharesy investor. I'm sorry, I'm a baby boomer, which means that I didn't pay very much for my house, which is now worth heaps more, but I did pay 20% interest rates on my mortgage for a while. I made various stupid mistakes over the years in my own personal investing life, but I have seen share markets come and go, interest rates as high as more than 20% on deposit through to today's 1% if you're lucky. So hopefully I can give a bit of a perspective. If you want to see the sort of things that we do on Business Desk, we're a business news service. We have a lot of commentary, a lot of specific information about managed funds and individual shares, and we just try to do a straight bet, fast, trustworthy job of telling people what's happening in the markets, and we are incredibly busy at the moment, as you can imagine.
Mm-hmm.
Yeah, hi. I'm Stuart Millar. I'm the CIO at Smartshares. I've been with Smartshares for around about a year now, and prior to that, extensive experience over 20 years investing diversified funds. So looking at asset allocations, things like managing currencies, managing portfolios tactically, thinking about macro markets, and having commentaries and views on that. Look, my role at Smartshares not only encompasses the ETFs that we manage, which are available to you through the Sharesies platform, but also the super life funds, of which we have both single sector funds where investors can make their own choices about where they invest their money, but also diversified funds where we are managing those funds for investors throughout the cycle. So really thinking about the long-term expected returns of various markets and asset classes that are best going to meet your long-term investing objectives.
Cool, thank you. So just to reiterate, tonight the panel will dig into why the share market's been so volatile lately, what it means for your investments, and what that might be, what the impact might be of that going forward. So we'll just kick off with some questions, but I thought it's a good place to start if maybe, Pattrick, you could give just a summary of what's been going on at the moment and why the share prices have been so volatile.
Summary of what's going on. Well, everyone's getting sick or worried about getting sick. I mean, what really strikes me about this particular situation at the moment with COVID-19 is is how different it is from the global financial crisis. We started our business at the time of the global financial crisis, and for a while thought we had made a terrible mistake. But people do actually turn to news services at that time. But then we were looking at almost a kind of a technological problem. The financial system froze globally because a whole lot of ultimately very difficult to understand and not terribly well structured financial instruments had been created by clever people in banks, which then poleaxed the global financial system. This is completely different. This is about life as human beings on the planet Earth. And we're trying to deal with a very fast-moving, very fast-changing, difficult to understand illness which hasn't previously been seen. And so it's a much more uncertain environment, and the potential, as we see countries starting to close down, for a very sharp and potentially fairly prolonged, when I say prolonged, I mean maybe a year, a bit more even, shock to the global economy is a real prospect. So trying to make sense of that, trying to get your own head around what that means, trying to work out even what I'm supposed to do with a staff of 7 or 8 in an office. Should we even be there? Should we all be at home? All these things are questions which then go to what is economic activity like? And there are no clear answers around any of this stuff at the moment, and so naturally people are concerned. I think in financial markets also, you're probably seeing some of the volatility in shares is about saying, well, there are a whole lot of things which aren't going to be trading the way that they have been, airlines being the most obvious and cafes being the most personal. Mm-hmm. But also it's people wanting access to cash. There are businesses that need, and individuals and households who need cash now because their normal cash flow has been disrupted. So people are cashing out in part in a flight to safety, in part because they need the cash, and in part because they can see that in the short term anyway, the prospects of the businesses that they've invested in are not what they expected even 2 or 3 weeks ago. So you're going to get people making quick decisions in large numbers, and you inevitably see volatility when that occurs. It doesn't mean that it's going to stay that way forever, though.
Mm-hmm. And so do you have anything to add there, Stuart, about what's kind of behind the activities that are happening at the moment?
Yeah, so look, the only thing I'll sort of add is really the stock market is very much a weighing machine. And so if you can imagine, on a global basis, we've got investors all around the world trying to work out what the spread of this virus actually means for the global economy, and in particular what it means for their own economies, and then ultimately what it's going to mean for companies and the earnings on a forward-looking basis. On a very short-term sort of basis, the markets have moved very, very quickly to price in a fairly severe downturn, if not a recession, and that sort of degree of panic is potentially risk spreading towards the economy and consumer confidence. One of the risks that we saw in 2008, often in 2008 when the liquidity started drying up with a number of the banks, out on Main Street, companies just wanted to lay off staff. Consumer confidence plummeted significantly, and what could have otherwise, what might have appeared to have been able to be contained within markets, or potentially just markets being fearful, actually resulted in a fairly significant economic downturn, which had a real impact on the economy and company earnings. So we've got to be quite real about what's going on at the moment, but equally we don't want to get too fearful, because markets are already pricing in a lot of uncertainty.
Mm-hmm. And so just going back to some of the concepts that you raised, because I will just try and catch things that maybe I feel like might need a bit more explanation as they come up. But you talked about liquidity drying up. Do you mind just explaining what that is and how that actually impacts things?
Yeah, well, firstly is liquidity is really just sort of cash available that companies might have to meet their short-term needs. And look, if companies aren't having cash flow coming in the form of sales, they have costs where they need to have money going out. They're not going to need to tap credit lines and things at banks, and then equally, banks themselves will need to have that sort of cash available to be able to lend out. And so, liquidity is generally right down at the core of it is managed by the central banks, and we've seen the central banks more recently act very swiftly to lower interest rates, so to make that capital available and make that capital incredibly cheap in an effort to, tie over some of these businesses and banks in the meantime, and just make sure that the cost of that capital isn't too high.
I mean, I think what I'd add there is that if you just take this in a New Zealand context rather than an international context, on Monday we saw the Reserve Bank of New Zealand cut the official cash rate to 0.25%. And that was the headline for all us journalists first thing in the morning. But actually, the most important thing that the Reserve Bank did was to delay its requirement that banks start putting more capital away, not for lending, but to place on their balance sheets to make them stronger for the future. The Reserve Bank is basically saying, this is one of those times when balance sheets strength is there to be lent on. We want you to be able to provide exactly that liquidity that Stuart was just talking about now. So we're not going to stand in the way of you making that kind of credit available to businesses that need it by asking you to hold more of it on your balance sheet. Now we're going to leave that requirement for a year. And in fact, we're going to say to you, if you don't lend that money, if you don't start dipping into the buffers that you've got in your capital balance sheets already, we're going to want to know why. And in fact, there's about $50 billion worth of credit lines there freed up immediately. And that's 4 times larger than the size of the fiscal package, the $12 billion fiscal package that the government announced yesterday. So you're getting 2 big things happening at once, 3 big things happening at once. One is very, very low interest rates. But frankly, the difference between 1% and 0.25% on the official cash rate is pretty mine it really. And if they basically ran out of ammunition long ago, giving banks the ability to lend more easily and telling them really that they must is a very powerful signal from the central bank. And then you've got the government weighing in saying, this is our first tranche of new spending, which it's a sort of a do everything it takes to save as many jobs as possible, to keep as much cash flow and liquidity in the economy as possible. Governments all over the world are doing this to varying extents, some bigger than New Zealand, some smaller. But in a New Zealand context anyway, we're actually in a reasonably strong position to do this stuff because of the way the economy's been managed over the last 25, 30 years.
So just to paraphrase and try to summarize that. So that's the Reserve Bank has dropped the OCR to make the cost of money cheaper, so then businesses can use that to then spend some money and to keep their businesses going. Is that
I'd say it's more than that. They've been given permission to use about $50 billion that they didn't previously think they had up their sleeves to make it easier to lend to businesses as well. They've been told to make life easy for their customers, and we'll sort it all out afterwards.
Yeah.
Yeah. I mean, look. I mean, one of the things there, maybe to note, in addition, is central banks, really lower interest rates and make that credit available ultimately to stimulate their economy, whether it's through further sort of business spending but also consumer spending. The last thing we need is to have consumers starting to all save at once and not spending. The economy will come to a standstill. The problem we've got here is that the consumer was actually in a fairly good position before. Consumer confidence was reasonably high. Household balance sheets weren't overly stretched, maybe a little bit more in New Zealand than some other places. And so, applying more liquidity isn't necessarily going to, in this sort of situation where it's actually just been a reduction in supply, which has caused consumers to stop spending. Necessarily giving them a whole lot more money isn't going to necessarily mean that they're going to go out and spend more in the short term anyway. Maybe in the long term.
You can't go to the pictures or go to a cafe if you're being told you've got to stay at home.
So it's around that there might be money available to spend, but people might choose not to spend it in environments like this. Is that?
The point I would make though is that if it's the relationship between a bank and a business that's going to have a tough few months, and they've got a bank that is being both encouraged and is able to see them through that period with greater ease, then they're going to have greater capacity to keep people in work and not fire them. They're still going to fire heaps of people. You can see that from Air New Zealand. They're going to reduce their workforce by 30%. And the Hotel Association today is saying that maybe 40% of people working in the hotel sector will lose their jobs, probably in the short term, because both those industries will come back once we have this virus understood and under control. But those are very big hits. And what the government is saying is the more that banks can support those businesses by giving them credit lines, which previously they might not have felt able to give. It's not about interest rates so much as the actual liquidity, the cash. Then we have a better chance of coming through this in a more orderly fashion. But that's the most you can hope for. It can only be a more orderly fashion, in my view. It's not. There's no nirvana here. It's going to be tough.
And so on that, what we've seen is quite a dramatic drop over the last few weeks in share prices. Some recoveries, sometimes when this has happened in the past, it can take several years to recover. How long do you think? I know this is, this is one of those. It is about your opinion. How long do you think it will take markets to recover, given how long the virus is likely to be around? So that's a question that we've had from the people listening.
Why don't you have a crack at that, Stuart? I'll give it some thought.
I guess it's the $1 million question, isn't it? How long is this going to take? Look, I really think it comes down to how long the quarantining and the social distancing needs to be in place to have some comfort that borders can be reopened, we can all go out and start sort of spending again. But the thing is, like the stock markets, they will start to weigh up. To what degree is that uncertainty around the economic outlook likely to become less worse? So as we get to see, I guess, some of the actions taking place internationally actually starting to work, we can kind of model up how long it might take before we can get out and go on business as usual. And
what are some kind of signals that we might see there? Like, when you say looking to overseas, what are some things we might see?
Probably just some signs that the spread of the virus is slowing, so potentially past the peak. And that usually coincides with probably being past the peak of greatest concern. And then once analysts can start sort of modelling up what the future expected earnings are of companies again, then they can kind of start pricing or determining what's a fair value on some of these companies. And therefore, you will start to find a bit of an equilibrium in prices that is more based on the longer term fundamentals. At the moment, it's just a complete unknown. That's why we've got this big dip down, like we saw 12% down in the S&P 500 the other day. Possibly a degree of capitulation, and sometimes that can be a sign that there's an excessive amount of fear in the markets. But it's still going to take some, probably, I'd like to say weeks, but it's probably going to be months before you can really get a fix on things. And so markets are likely to be volatile for a time. And that's why I don't believe that this is necessarily going to be a pure V-shaped sort of recovery, but rather one that's a bit more U-shaped, not an L, because we've got governments around the world ready to apply fiscal stimulus and almost re-kickstart the economy. And so, have a little bit of faith in that. They may not come to the party immediately, but it will eventually come. And so as long as we start to see some of the risk premiums associated with that uncertainty going away, then equity markets can start to perform again.
I suppose I think about it in terms of how long ago did I first hear about the coronavirus? It was probably sometime when I was on holiday in mid-January. Between then and now, it's gone from, do I even care about this sniffle in China, to, oh my God, are parts of my business going to survive? I look at China, though, and say, in China, we are being told, not that I particularly trust Chinese statistics or government pronouncements on anything much, that China is starting to go back to work, so about 3 months on. Mm-hmm. If you imagine that that's going to be a sort of pattern across the whole of the world economy, with fits and starts, and not everybody being at the same place at the same time, and different countries doing better than others at controlling the thing. What I had originally thought might be a 3 to 4 months problem, which would start to come right, I would now not be surprised if it's more like a 12 to 15 month problem. That's not anything more than a guess by a journalist who's watching a lot of news going through, mm-hmm. And talking to a lot of economists and getting the sense that it is going to take a wee while. What everybody agrees, though, is that once this thing either starts to fade out, gets around to its second season and isn't as virulent, we have a vaccine, the world economy, is absolutely no reason why the world economy won't come roaring back. I mean, quite apart from anything else, going to have a whole lot of people who haven't been able to go to the pictures for the last 6 months. We're desperate to get out of the house. There will be a strong bounce back. It's just we don't really know when. And it's a terrible analogy. It reminds me of when my eldest daughter had a colic as a baby. About the second day, I thought this is never going to end. And, eventually it did. And I looked back and I thought, that didn't actually last that long. It'll be like that.
So I guess that kind of leads into a bit of background around, have things like this happened before, and what can you tell us about events like this that may have happened in the past? Like market dips or share market drops like this?
Yeah, look, I think one thing you can do is really just look back at other times in history when we've had other viruses. SARS is a particularly well-known period back in 2003. It happened to coincide when I was probably a fairly young analyst, but what I found interesting at that time was my investment manager at the time wanted me to track the number of cases and physically within a spreadsheet. Now this sort of information is readily available to all of us, and so we can start to see and we can visualize and get visual models online to be able to track these sort of things and try and ascertain what's happening in the economy. So the flow of information is much more rapid than what has been in the past. If we were to go back to a number of the different times like 2003, 2011, when we had various sort of viruses. I think Ebola was within there, and there's some really good charts floating around. And I suggest people to Google it. They have had short-term impacts on the market, some of them more severe than others, and with them has come the same degree of uncertainty around the impact on the economy. But invariably, as soon as that comes to pass, the markets do ultimately recover. And so if you've got a longer-term investment horizon, you can actually potentially use some of these periods of uncertainty to pick up stocks at some very good prices. And I think that's particularly important for younger generations, younger people that are accumulating assets at the moment. They're saving for their retirement, which might be 20 or 30 years away. You want to be buying these companies and investing in markets at cheap prices. And so in some ways, you do want to have a bit of a downturn in the market. It's not really going to help people that are closer to retirement. But if you've been invested into the right portfolios, if you had the right advice, and you should see a financial advisor if you haven't, if you've had the right advice, you should be put into funds that have the right risk profile that suits your investment horizon. And so, if you are nearing retirement, you should be in funds that have a higher exposure towards bonds and cash. And equally, even people that still have a 10 or 20 year horizon, they should hold some cash and bonds and portfolios. I was asked the question not so long ago, why are you holding bonds in your balanced portfolios? They're hardly returning anything, and the cash fund isn't returning anything at all. You must be in stocks. It's like, well, look, that part of your portfolio is the insurance when you have these downturns. Mm-hmm. And what it also means is that you have some gunpowder dry to be able to allocate some money across to those stocks and property assets that are representing better value in these periods. So over the longer term, it won't have that bigger impact.
And I'll give you a personal view, if you like. I mean, as a business journalist, ironically, I don't feel that I can invest in individual stocks because I might end up writing about them, and then that's a conflict of interest, blah, blah, blah. Mm-hmm. But also, as a baby boomer who's paid off their house, I've got savings. And so most of my savings, or a big chunk of them, are in managed funds. And my attitude has been not to even look at what's happened to them over the last month. I'm almost certain that I've been decimated. But I also take the view that I don't need or want that money for the next 5 or 6 years, maybe a bit longer. And I would be very surprised if I'm not, if the managed funds that I'm in aren't buying right now, not looking for the bottom of the market, because you'll never pick the bottom, but saying value is starting to emerge in some sectors. And they will continue to do that. And I'm pretty confident, if I've picked decent funds, that they will do actually very well over that kind of period of time. If you're trying to make money in this market right now, you're completely mad. Unless you're day trading, in which case do remember that we do have a capital gains tax in place in New Zealand for that kind of activity, and it's a monk's game in my view to be trying to do that. You've got to take a longer term view at the moment. And as Stuart said, I'm sure Jane will talk about this more in her segment. Mm-hmm. Just be clear about what your risk profile is. If you want your money next year, don't put it into high risk shares. If you want it in 20 years' time, just take a deep breath. This will pass.
So when you say if you're trying to make money, you mean today? Like if you're trying to make money today, that's not like unless you're day trading. But it's more about taking a longer term view.
I just would be concerned that there are a lot of people that I know who are looking every day at their KiwiSaver account, or looking at the shares that they own, mm-hmm. and having a damn good worry about the whole thing, saying to themselves, should I be getting out? What should I be doing? And I don't know that there's any kind of, you're never going to beat the house on that as a person sitting at home. I don't know what you think about that, Stuart, but lots and lots of very smart people are sitting on massive paper losses at the moment, who are just saying, breathe, wait, get into the things that you're going to do well. I mean, there are some opportunities out there at the moment. Anyone who's selling face masks, sanitizers, in-home entertainment options, dried food, apparently lavatory paper, God knows why we all need so much of that, are all doing fine and will probably do quite well. Anybody who does video conferencing probably has a fantastic market opportunity right now. And in fact, one of the things I would be looking at if I were an analyst would be to say, how much will this change the way that the business world operates? How much real recovery or how much lost recovery will there be for the airline industry, for example, once people work out that they can actually effectively do things without travelling?
Yeah, look, I couldn't agree more. And look, sometimes the best thing to do is just to do absolutely nothing. If you're not really sure of what you need to do, if in doubt, just get out. Just don't sell either, but just stay invested, and really think about what your longer term goals are. In fact, I think it was like during the .com sort of crash. I had a friend sort of really worried about their position. They had themselves fully invested in a broad exposure to stocks, so they weren't heavily invested in tech stocks or anything. I just said, look, probably the best thing to do right now. Market was already down 50%. Just turn your screen off. One of the problems we have these days, we have too much information, and it is really, really worrying for people. When they are investing for the long term. So people that are in KiwiSaver funds, as long as they're in the right fund, and age step models and life cycle models, they are quite a good way to go. If you're invested into the right diversified exposures, you are prepared for the long term. So I'd suggest sticking with that.
And again, this is not a financial system problem, which the GFC was, or to some extent the 1987 share market crash, which some people still remember, and which really had a big impact on New Zealanders' willingness to invest in anything relating to the stock market. I really hope that doesn't happen again, because it was so knuckleheaded, really. It was almost like, I remember those times, but we deregulated a lot of things in the economy, and suddenly there was all this fantastic frothy opportunity. On this occasion, it seems to me that although it isn't really widely recognised, a lot of people who sort of feel we've been living in the shadow of the global financial crisis since 2008, actually, share prices have been booming for almost 12 years in a row. That never happens. If you looked at a chart right now of the global share market index, we're probably back to, where would we be, Stuart? October last year?
Yeah, or midway through last year, maybe a little bit more.
And we all felt rich then. So just you need some perspective on the extent of the run-up which has occurred over such a long period as well. And if you're an optimist about the future, then you would say that we will get through this. It's related to a health issue which ought to be containable by clever people with decent government over a period of time, and therefore, as long as you haven't got everything invested in airline stocks or some other sector which clearly might change substantially as a result of all of this, or won't see it through, if you're invested in a very weakly capitalized company in the tourism sector, for example, would not be a great place to be right now, I wouldn't have thought, then you should be relatively confident that you'll see growth again. You just got to be patient.
So when you talk about the difference between it being a financial, say a dip that's caused by financial versus this, do you mind just explaining a bit about the difference of that and how that plays out quite differently?
Well, I'll probably explain it in a more sort of agrarian way than maybe Stuart would. He'd probably do a better job of it. But basically the way I think about it is that when the banking system freezes because of things that it's done to itself, that's not the whole world economy drawing breath and everybody staying at home and schools closing and a level of fear affecting the way that everybody behaves because they're concerned for their own personal safety, their own personal health and well-being. They might be concerned during a financial crisis about their financial well-being, but that's quite different. That's existentially different from worrying about whether you're going to get sick, whether you might infect your elderly parents and one of them might die. That's completely different. And so it's just a different set of issues. And the global financial system is in much better shape than it was at the time of the GFC. It's better capitalized. The ways in which liquidity can be injected, well, some of them are rather experimental, but they've certainly been much more used and better understood. The capacity for the financial system to come to the party is there, whereas it wasn't in the GFC, is what I'd argue. And in New Zealand, not in all countries, but in New Zealand, we actually have strong enough government accounts to mean that the government can confidently spend really serious sums of money, far more than we've already seen, to keep things as afloat as possible, bearing in mind that people will start not wanting to go out at all. And the international rating agencies will not even blink an eyelid.
And look, I think that speaks to exactly why I believe that the fiscal response has got to be meaningful and be effective, because it's a Main Street problem. This is going to affect the economy. It's not just from some sort of agrarian issue where where you're potentially going to create a moral hazard. People investing non-prudentially. So. So I think you answered that really well. I won't labour on that point. But Sonya, I'm just wary of time. There is a question on there I just wanted to address, if you don't mind. Is that okay?
Yeah, go for it.
Yeah, look, so...
Just reiterate the question.
So Sarah just asked how demand for liquidity is affecting Smartshares funds. Are you having to sell off stocks into the market, or are holdings stable? Now, I think this is fairly important part, and a big part of what I do every day is really looking through the markets and trying to see whether this market dislocation is exposing some sort of systemic problem with the market as such. Now, there's been a lot of concerns that exchange traded funds, there's been a lot of flow of money into exchange traded funds and passive money, and there's been a lot of concern that's potentially inflating the market. Now, when you have a downturn like this, you would expect to see if that was causing a mispricing, or if there was some sort of issue with that, you would see a significant dislocation in that part of the market. Now, what we're actually seeing is some of the funds that performed the strongest have continued to perform relatively well. So some of those funds that have a bias towards things like healthcare, technology, some sort of any sort of growth company or a company that has a sustainable growth. Now, ETFs are generally tracking an index, and a lot of those index are market cap weighted. So when the stocks fall within that index, they fall at a commensurate amount within the index, depending on how quickly each of those individual stocks are repriced. So what that means is that we don't have to sell any securities at all. The portfolio stays weighted accordingly. The main thing that we do every day is make sure that when people are pulling money in and out of the ETFs, we ensure that they are fully invested, and that when we make that liquidity available, that we're not having a huge impact on the stocks that are sold. And in fact, what happens is that you'll have the market makers will go out into the market, and they will sell the securities, and then we will cancel an ETF. So basically, the outstanding ETFs are reduced. So we're not actually going out and buying, selling stocks ourselves to meet those liquidity needs.
Cool. Thanks for that, Stuart, and thanks for picking that up from the question. So just conscious of time, I think we've got time for one more, and I think where it would be really interesting to kind of end this is just any thoughts you have for what investors should be doing now. So if you're investing, what are some things that you think people should be doing?
I think I've probably said what I think people should be doing, which is drawing breath. As long as you're in a managed fund and you've got your risk profile sorted, there's probably not a lot that you should do, other than have some confidence that markets tend to recover, and that there's 7 billion people plus in the world who want to eat and watch television, and go out and fly and own cars and all of that. So that's not going to go away. There's one comment here I just really wanted to pick up on, which I think is worth thinking about in the context of the real economy rather than maybe the investment economy, but maybe something to keep an eye on. And that's Dimitri says, maybe this will be so disruptive that we may reinvent everything. I have to say that as a business journalist trying to work out what to do with my business and talking to a lot of business people about what they're doing with their businesses, both big and small, that's what I see the most of is innovation. People, when thrown a problem, don't all just go and weep on the couch. They actually say, what should I be doing about this? And the thing I keep hearing constantly is, we're doing this thing that we said 2 years ago that we should do, and now we have to do it, so we're doing it. And for some businesses anyway, that's actually quite liberating and really interesting. And people going, oh, so maybe that means we can do that and push into that new market that we didn't previously think we knew how to do. I'm experiencing this myself, and I think just a little bit of belief in the capacity for human invention to cope with circumstances is important at a time like this, because it's very easy to think the world's going to hell in a handcart. This is the latest example. Actually, people will rise to the challenge on this, and there's a weird kind of capacity for optimism in the middle of it all. And in terms of an investment horizon, if your investment horizon is not very short, I'd hang on to that.
Yeah, I'd just encourage people to continue to invest, but for the longer term. Keep your longer term objectives in mind. A lot of investors are either Kiwi savers, and then any sort of other cash outside of that is some additional sort of investments that they're making. And looking for opportunities, and look, by all means, if you think you see an opportunity out there in the market, do so, but don't put any money at risk that you can't afford in the near term. So make sure that you can continue to hold that position if you do have that volatility. And if anything, if you're going to be taking adding to your portfolio, adding to your risk because you think markets have discounted the uncertainty sufficiently, maybe do that in a number of licks. So put some money to work now. Maybe some a little bit later when things get even worse, and then as things start to improve, add to that again. So you're effectively averaging in over a period of time, and over the long term, I believe that'll serve you well.
Cool, thank you. So massive thanks, Stuart and Pattrick, for being a part of this and for sharing everything that you've shared.
No problem. Thank you.
Thanks.